Hello and welcome back. I've often talked about volatility, and I have an interesting example today that we're going to discuss on a chart, along with a few other things that go along with this particular chart. This is Kraken XMR. This asset has been one I have been using to test the support and resistance pullback, and if you're a subscriber, you have seen that in the technical analysis areas on the Discord server. If you're not a subscriber, the link will be below, and you're missing a lot of good content, including the source code for the strategy that I'm going to be discussing today. So as we move forward in looking at this chart, we can see many things. Most notably, this gap. And yes, sometimes it happens where charts have gaps in them. It could be the service provider, it could be the reporting process, or it could be the program itself was offline for that time period. There are no ways of really predicting when such things are going to happen, and you simply have to roll with it, to accept that that's just part of algorithmic trading and move forward with your process. But before we really get into the details of this strategy, let's look at it, because really this is quite fascinating for a chart. Outside the gap where, for whatever reason, just isn't there. We have to deal with that. The best way is just to pretend it doesn't exist, which is what applications like TradingView or NinjaTrader or MetaTrader often do. They ignore the gaps. That really is the only real way you can handle this kind of a situation. So as we look at the chart, we can see that XMR has done quite well. But it's in a downtrending situation. It's losing price. So as we see how this price interacts, we can see that the market is trending downward. That's important for our support strategy, as we're going to be seeing in a few minutes. So let's take a look at the details of the chart. And we have quite a few details. So let's look at the support and resistance. There's the resistance line. There's the support line. And of course we see how the algorithm deals with the gap. That's fine, that's great, that actually makes perfect sense. So we see the algorithm, and this really looks very nice. We can see the points of when the pullbacks would take place and how those pullbacks would actually generate revenue as the strategy continues to unfold. But there's one part of this chart that's missing. The part that really describes something unique. So let's turn off these various values and let's talk about volatility. What a hot mess this is. And it's always been one of the biggest problems with trading, when you need to take into account the volatility of your purchase and sells. We can see on the chart clearly we have an area of high volatility and an area of low volatility. How do we pick what volatility we want to use as we progress through buying and selling? Do we pick the highest? Do we pick the lowest? Or do we pick some kind of a moving average that kind of follows this crazy pattern? That really is a risk management or risk assessment approach. I personally always tend to lead to the highest as my baseline and apply it across the board to my trades. But there are some very significant downsides to that approach. If you have a weird situation like the gap or some other kind of exchange glitch, it could skew your numbers dramatically. And then you're going to have to edit your data flow to bring them back into balance. If you end up with a period of a calm market, taking the highest volatility could cause you to not get as many trades as you could have gotten. The downside to that, or the opposite, if you were to take the lowest volatility, you might actually lose money even though you've won the trade. If you take the average, you're kind of in the middle of the road where you might win some, lose some as you go. But volatility is a risk process. You have to decide your risk. Because if you use the approach I use, you take the price of the asset plus the volatility plus the spread. And that becomes your position size. So now that you have your position size, you do the same thing when you go to sell. And that is, your selling price is also going to be the current price you're watching plus the volatility plus the spread. And the current closing price or ticker price must be greater than that amount. So you have a situation where you're trying to maximize your profits and minimize your risks by dealing with the various points of slippage that the market might have already in it. And that can be very difficult. But as you look at the values, you can see that they're not that big yet. Over time, say a year or 2 years into trading this strategy, that might be different. You might end up with a much higher and more significant volatility level. But the overall process of your volatility is something you must consider in being able to mitigate your risks of bad positions. You can also factor volatility with an average true range metric to try to figure out where volatility should be in all of this mess. But there's a lot of different ways to look at this type of a situation. And that's really the whole point of the Jackrabbit Technical Analysis Library, to give you ways to look at something beyond regular conventions. So whether you're looking at the average, the highest, the lowest, or even the median, always consider volatility in your process, because it's going to affect your slippage levels. And by being able to predict this type of a situation in real time, you're able to gain information about your market. And that information is what helps you become a better trader. You may even want to work on a whole different level for this, where you might want to actually look at volatility through an RSI aspect, or even try to apply a Bollinger Bands aspect, and use volatility as a metric for buying and selling. Again, there's so many different possibilities here. And that's really the whole point of why the Technical Analysis Library is such a cornerstone for being able to find your edge. Because it doesn't give you just the blanket, here's the indicator, and now go out into the world to make money. That doesn't work. The world has grown, and traders, specifically, people like you and I, we've started using tools much more intelligently, looking for opportunities that most people ignore. And that really is the whole point of what this is about. Finding the tools necessary to being able to get profits out of the market. So as you look at this, remember the source code is available. If you're a subscriber, the link will be in the description. How do you use volatility in your trading? Do you track it constantly like I do? Or do you only track it when you're about ready to make your purchase and selling points? Let me know. Share your thoughts. Thank you for watching.